All right, so we're going to move forward with the long-term debt section of Chapter 6. And long-term debt is what it sounds like. We're borrowing for long-term, which typically means more than a year. And so again, I'm going to walk you through the process of recording a long-term debt. So this will be to record the receipt of money from borrowing for long-term debt. So I'm going to go ahead. Step 1 is continue where you left off. Step 2 is click New and click Bank Deposit. So again, we're just telling QuickBooks money's coming into our account. And then we're going to select Add New from the Received From column on the Add Funds to this deposit section. So right here, I'm going to add new, and I'm going to put Bank of La Jolla. Make sure it's selected as a vendor. Hit save. We're going to accept the date that it already assumes for us. Step 6 is we're going to select notes payable from the account here. So notes payable just means a debt, a long-term debt that I owe. A note is actually a piece of paper that has all the terms of the borrowing on it. And so a note payable just means the note that is payable that we owe to someone else. We're going to show that we received the money as a check in the amount of $15,000. So again, this tells, whoops, I always do that, don't I? This tells QuickBooks that we are receiving a check from the Bank of La Jolla for $15,000, and it's increasing our checking and increasing our notes payable. So it's money that we've borrowed. Step 9, we're going to hit save and close. All right. So in step 10, now we're going to show paying back of a loan. So step 10, I'm going to hit new, and I'm going to record check. Remember, check is a way of telling QuickBooks money is getting paid out. Step 11, I'm going to hit add new for my payees, and I'm going to enter the name Bank of San Diego. Make sure it's a vendor. It already is, and click save. So I've added that new vendor. I'm going to accept the payment date. That was step 13. Step 14, I'm going to select notes payable. And then I'm going to type 25,000 in the amount line. Then I'm going to add another one here, add new, and it's going to be an expense account. That's step 17. Step 18, we're going to select interest paid as the type of expense account. And then we're going to call it interest expense. We'll hit save and close. So now we've added the interest expense there. And we're going to type 1,000 in the amount box. That's step 20. All right. So now what we're telling QuickBooks is write a check. So $26,000 is going to go out of our account. And 25,000 of it's going to pay off a note payable. And 1,000 of it is going to pay an interest expense. So there's sometimes gets confusing is how do I know if the money's going up or down? And the answer is by the bank account I started with. So if I choose a check, that means I'm paying money out of the company. And so the cash in the checking account will go down, which means I'm paying off the note payable. If I had chosen bank deposit, that means my bank account was going up, which means I was receiving money from a note payable. So that's kind of how it's different than a journal entry. By choosing either a check transaction or a bank deposit transaction, that's telling QuickBooks whether or not your cash asset is going up, and the other account that you're using is either going up or going down. All right, step 21, we're going to hit save and close. And that's the end of the long-term debt section of chapter 6.